Record keeping is fair game on all three parts of the EA exam. The core standard is simple. Keep records that clearly show income, expenses, and basis. The code usually doesn't demand one magic document type. Instead, the rule is keep whatever you'll need to administer any tax provision that applies to you. On exam questions, the trap is thinking record keeping is only about deductions. It's also about proving income and proving basis. Basis drives gain or loss, depreciation, and even whether a distribution is taxable. If you can't prove basis, the IRS can treat it as zero. That's why defensible files aren't optional. Substantiation beats estimates. For many expenses, you need adequate records, usually written records, including computer logs. If you're guessing, you're losing. On the EA exam, they love wording like about, roughly, or estimated. That's your cue. The deduction is generally not allowed unless the taxpayer has proper documentation. Think in document categories. Financial documents are your bread and butter. Receipts, canceled checks, bank and credit card statements, brokerage records. Legal documents matter when facts change, like birth certificates for dependents, divorce decrees for filing status or support, and settlement agreements for taxable income decisions. For business and entity returns, the proof often lives in organizational documents. Partnership agreements, corporate bylaws, and corporate minutes can explain who owns what, who has authority, and how allocations or distributions work. If you're preparing the return, you may need to review these to support positions taken on the return. Some expense areas are especially documentation heavy. Travel, transportation, gifts, meals, and similar items are common audit targets, so logs and receipts matter. Charitable contributions are another classic. You want receipts, and for certain donations, you need written acknowledgments, especially when the contribution is $250 or more. Now switch to the preparer perspective. Part 3 loves asking what paid preparers must retain. The rule isn't keep everything forever, it's specific. Retain either a copy of each return or claim for refund you prepared, or keep a list of those returns. And you keep it for the required period, generally 3 years. With regards to tax returns that are prepared for compensation, what records are tax preparers required to retain? The choices include keeping copies of all returns or keeping a comprehensive list, keeping only physical copies, having no special requirements, or keeping copies where physical or electronic versions are acceptable. Think about it. The correct answer is copies of all tax returns prepared, or a comprehensive list of tax returns prepared. Under IRC Section 6107, a paid preparer can satisfy the rule with a copy or with a list. A tempting wrong choice is the one that says you must keep copies, physical or electronic, because it forgets the or list option. With regards to federal taxes, the statute of limitations for assessment refers to what? Options include the time the IRS can collect, disbar a practitioner, charge a felony tax crime, or assess a tax deficiency. Think about what assessment means in IRS language. The correct answer is the maximum time period in which the IRS can assess a tax deficiency. Assessment is the formal act of recording the tax liability. The tempting wrong answer is the collection time period, because people mix up assessment and collection. But this question is specifically about assessing additional tax.